Thank you guys so much for joining us today. Appreciate it so much. And guys, I'm going to open this up as always. Have as many questions as possible. If anyone is not registered to YouTube yet, please do so. I have created many topics on this in the past, and it is going to be something that is very worthwhile for you to review certain concepts, like what exactly is a naked put? What is a covered call? How does it work? How do I make it work for me, right? These are all things that you're going to want to know, okay? Can everyone verify if you can hear me and see me? Let me know. All right, guys? If you can, that'd be great. Can see now. Okay, thank you, Rita. Appreciate it. All right. I am going to try my best to get this thing going in as soon as possible, but I'm having a bit of difficulty sharing my screen here. So just give me 1 second. I'm going to share my screen. I've already got my trading app open, guys. So like I said, what we're going to do is we're going to go over a few sample trades today behind the backdrop of what is happening. And this is a great long-term strategy. Just to give you guys a bit of background of what happened with me, is when I graduated from university back in the late 90s, early 2000s, well, late 90s, I had no idea what I was doing, how to get out of my predicament in terms of I was in a position where I was in, I had a substantial amount of student debt. I had no idea how to get out of it. And I'm just trying to show everyone that anyone can do this. No matter who you are in this world, you can get out of your predicament through knowledge and application of that knowledge, okay? So today's sample session is simply going to be how I acquired my real estate properties. Okay, so what I did over the years is what you're going to see is a few trades. In these trades, I collect a bunch of money. From that, I'm able to take that money and turn them into real estate assets. I can buy more stock. I can do all kinds of things. So that is the idea, okay, guys? So just give me 1 second. And again, like I said, if you guys have any questions, so we're all good there. Tulan, Davo, Rita, all good. Okay, all right, so you guys can all see my video. I'm going to share my screen, okay? Give me just 1 second, and I'll be back with you guys, okay? So any more questions, please address them. Is there video? Of course there is video, yes, absolutely. So what we're trying to do here, guys, is we're trying to collect money and premium on stocks we would already buy anyways. And like I said, this is an absolutely game-changing concept. If you can buy your favorite stocks for cheaper than they are trading for, that is a place that you want to be, guaranteed, okay? You want to be there. You want to be able to you buy your stocks. Actually, I shouldn't say guaranteed. Sometimes you are better off buying the stock because if the markets are really low, you're better off buying the stock because the appreciation will be greater. But over a period of time, in my opinion, if I can get paid a bunch of money to buy stock for cheap, of course, that's what I'll do. Absolutely. Why would I not? Right? Okay. So here is a sample trading account from Interactive Brokers. Okay. And the reason I want to show this is because before you begin to trade, what you want to do is you want to open up a simulated trading account. As you can see there on the top, you can see in the light that a big yellow line says simulated trading. All right. So what you want to do is, as Muhammad Ali said, you want to practice in the gym instead of bleeding the ring. You do not want to bleed in the ring, meaning you don't want to make these mistakes for real. You want to make them before you begin with real money, okay? So here is a sample trading account, okay? Now this account was started with $1 million on January 1st. Now we're up to $1.026 million. So a pretty good return. However, that is not the point. The point is to show you guys how this works. And why, in my opinion, after you learn this, you will never, ever go back to trading stocks the same way again, okay? So the first thing we do here at Theta is we identify stocks in companies that we want to own. So for example, if you want to buy stock in whatever company it happens to be, you will be a part owner of that company. So you want to make sure that that company is going to be a very strong company for years and years and years to come, okay? That's the first thing. Without that, we have nothing, all right? All right. So let's make a couple sample trades here, okay? So what we're going to do is here, we're going to look at our watch list here in the bottom right-hand corner watch list. These are all the stocks that we like. Now, if we say to ourselves, there's two different approaches here at Theta, okay? You don't necessarily have to trade stocks. What you can say to yourself is, I don't want to trade any companies. And like I said, if you're trading a stock like Apple, AAPL, you are a part owner of that company. You're going to be expected to know how the company works, why it works, how much earnings they'll have in the future, et cetera, et cetera. You will be expected to know a lot about that company. If you do not want to worry about that, that is no problem. What you can do instead is you can agree to buy the entire index, meaning a bunch of companies all rolled into one. For example, if you buy here, for example, the SPY. This is the 500 biggest US companies in the United States, okay? The 500 US biggest companies, all right. And you say to yourself, you know what? I don't want to worry about one particular company going up or down or sideways. What I want to think about is, do I think the economy will be better? Do I think the stock market will be better in the long run? Now, keep in mind, guys, the stock market has gone up on average, okay? And this is the S&P 500, which this is an ETF of. That has gone up about 11% a year for the last 50 years. So you ask yourself a simple question. Okay, if I know that this thing has gone up about 11% a year, the odds are heavily in my favor that it will go up over a period of time. Okay, so let's say I go back 5 years. I'm gonna look at the price of where this was 5 years ago. So 5 years ago, the S&P SPY ETF of the 500 biggest US companies was trading at 274. Now it's at 398. Okay, well, that's great. We know on average it goes up about, like I said, about 10.9 or 11% a year. Now, every so often you have a major decline. So here, I'm showing a major decline during COVID. Okay, right here. Huge dip. The market did really well after COVID, and then it has done really poorly since then. In 2022, the markets did not do well at all, okay? But what you're looking at is you're looking at a longer term picture. You're like, how can I make money off this position, off the overall economy over a long period of time? That is what we're looking for, okay? Our first goal here at Theta is to never lose our money, okay? So what we're going to do is we're always going to put ourselves in the worst case position that we own high quality stocks, or in this case, an ETF that we like over a long period of time. So you can see here that the SPY is trading at 398, okay? Okay. In the last year, it's been all the way down to 348 and all the way up to 458. But we know that over a period of time, it has gone up historically. There's no guarantee in the future. You never know what happens. But as long as humanity keeps operating the way it is, one would expect that the market would hit an all-time high. Okay, so instead of buying it for 398 here, what I'm going to do is I'm going to agree to buy it for a lower price, okay? And I'm going to go out roughly 30 days. So you can see here, I'm changing the dates here up at the top. So I have here March 31st, 2023, and that is 31 days. So what I'm going to do is I'm going to agree to buy this company for a lower price, in this case, not a company, but an ETF, all 500 companies rolled into one. I'm going to agree to buy it at a lower price than it's actually trading for, okay? So I'm going to go back out here and scroll here again, and I'm going to take a look at my technical analysis, okay, which is, kind of a study of these lines, all these weird lines. What do they mean? You got a 200-day moving average, you got a 20-day moving average, and that's SMA, RSI, BB. These are all like, what does this mean? We'll teach you what all this means, okay? And you say to yourself, you know what? I'm going to agree to buy this thing for the SMA 200, which is a 200-day moving average, okay? And that's a big indicator when it comes to technical analysis, okay? So it's trading for 398 today. And again, I think the economy and the stock market will be further ahead in a year, 2 years, 3 years. That's my thought process here, okay? Why? Because again, if I go over time, it's gone up about 11% a year for the last 50 years. Now you might have a plus 20% year and then followed by a 0 year or a negative 5% year. That happens. Last year, we actually had a negative 20% year. Very unusual. But there is a lot of opportunity in that, okay? So again, the SPY is trading at 398. And we look at our technical analysis and we say to ourselves, you know what? We'd like to buy this thing about $393 a share. So that's what we're going to do, okay? That's the 200-day moving average. So I'm going to go to March 31st here, and I'm going to go to 393, okay? And you can see here, guys, I'm getting paid about $7.05 a share. What that means is someone is paying me about 2% for 1 month between now, February 28th and March 31st, roughly a 30-day period, okay? I'm being paid $7.05 a share divided by the 393 that I would have to put up if I had to agree to buy this company, or in this case, an S&P 500. And I'm going to go ahead and do this trade, okay? So the worst case issue that's going to happen to me here, guys, is that I have to buy all 500 S&P companies here that are rolled up into this index. I'll have to buy them at 393. Well, the point is, guys, I would have bought it for 397 or 398 anyways, because I think it'll be worth more a year from now. So why are we getting paid a bunch of money here? Well, we're getting paid a bunch of money here, in this case, over 2% for the month, which is $7 divided by 393. The reason we are getting paid so much is because somebody is looking to buy insurance. So the person who holds shares in SPY or stock in SPY, okay, which is the 500 US companies, biggest companies, is saying to themselves, you know what? No matter what happens, I have to make sure I get $393 a share, no matter what happens. Well, what they have to do is they have to buy insurance. So they will go ahead and buy insurance. In this case, we are providers of that insurance. That is what we do day in and day out here at Theta. We provide insurance. So in this case, as you can see, the SPY is at 398. Basically what we did was we guaranteed a buy price, guaranteed, no matter what happens. Even if the price goes lower, we have guaranteed a buy price of roughly $7.09 a share. $393. We got paid $7.09 a share. So remember, this S&P 500 ETF is trading at $398. What we said to ourselves is we're going to buy it no matter what happens at 393. So think of it as, maybe someone who's looking to sell a property and the real estate agent says, you know what, I'll guarantee a buy price of this price, whatever that price happens to be. The difference is the realtor will only guarantee a buy price. In the stock market, what you can do is you can guarantee a buy price and you can get paid a lot of money just for guaranteeing that buy price. Now, even if the stock happens to go down to $385 a share, it doesn't matter to me. I'm still going to be buying it for $393 a share, no matter what. Even if it goes to 380, that's why I'm being compensated 2% for the month. I'm being compensated that much money because I am guaranteeing a buy price. So, for example, if that person who is looking to sell their shares in S&P 500 and they're saying to themselves, you know what, I have to buy a house in 2 months. I need to make sure that I get at least $393 a share. they will purchase insurance. We are the providers of that insurance. And like I said, the reason we have no problem providing that insurance is because we are more than happy to own, in this case, the SPY ETF for $5 below its market value. Okay? Now, you can either do this with the index, like I just showed, okay? Or you can do it with an actual stock itself. So in this case, let's look at a couple of stocks. Well, first one we're looking at is Tesla, okay? Before I do that, I'm going to address a question here. Sultan asks, why if they only trade stocks? Aren't a diverse portfolio that includes stocks, ETFs, equities, and a bit of crypto is more suitable, especially inflation? Good question, Sultan, and that's an individual question, okay? So if you think there's too much risk in one stock, totally agree with you, okay? But oftentimes, people have large portfolios and they say to themselves, you know what? I want a bunch of stocks. If you say, you know what? I don't want a bunch of stocks. I only want one particular thing which encompasses all the things that you talked about. You know, stocks, ETFs, equities, crypto, maybe, I don't know if you can find something that encompasses all that. Let's say, for example, we look at QQQ, okay? Now, QQQ is this top 100 stocks of NASDAQ. So all the top 100 companies. This includes Microsoft, Apple, Tesla, Google, et cetera, et cetera, et cetera. All the top 100 technology companies, all rolled into one, okay? So you say to yourself, you know what? I don't want to worry about analyzing how good one company is and where they may be. I don't want to worry about that. I totally get that. The great thing with our strategy here at Theta is that you don't have to worry about one particular company. What you're looking at here is how does technology do over a period of time? Again, like I said, technology has historically performed very well. So 5 years ago, this index was a lot lower than it is today, okay? Way lower. We can see we were all the way down to 173, and now it's at 294. So the odds are, again, on our side, that the stock market, or in this case, the ETF, goes up over a period of time. So same thing we're doing here again, okay? So we say to ourselves, you know what? I really like technology, and I think technology is going to do really well in the next 1, 2, 3, 5 years from now, or even, you know, I think it's going to do really well. I'm happy to own it. That's the bottom line. Okay. So if you're happy to own technology, in this case, mostly technology, great. Okay. So you say to yourself, okay, I want to buy some of this QQQ stuff, but I don't want to pay $294 a share. I want to pay a little bit less than. Okay, great. So we're going to take a look at our technical analysis, okay? And we can see here, there's a lot of different metrics. Our lower Bollinger Band, BB20, 2.0 low, is at 290. Our simple moving average, SMA 200, is at 290. You know, that's a pretty good point as to where I'd like to buy this. So what, again, I'm going to do is here, I'm going to go to the options market, okay, on the top right-hand corner, options and spreads. I'm going to press this button, okay, and I'm going to go out for, again, around roughly 30 days, and there's a very specific reason, guys, that we are going out 30 days, okay? We are going to guarantee the buy price on these QQQs for 30 days. So essentially, we are providing insurance for this QQQ for 31 days in this instance. And we're saying that no matter what happens, we are going to guarantee a buy price of $290 a share. Why? Because that is where our technical analysis lies, okay? So let me go ahead and make this trade, okay? So you can see I'm going to order, and I want to do a sell order, not a buy order, but a sell order, okay? So I'm going to change this. And guys, this platform, by the way, is known as Interactive Brokers. You can use any platform you wish. However, this is the one that we choose. Why? Because it's cheap. It's direct to the market, meaning no middle person in between. Okay, I don't want to get too much into what that's like right now, but if you see sometimes there's no trading fees involved, that's generally a lie, and there is a spread in between. So this, and again, we have no affiliation with Interactive Brokers. I've been using them since about 2005. I just find they have the best execution possible. Okay, so I am going to agree to buy in this case situation here the the QQQ, which is the top 100 stocks of the Nasdaq, which is a tech-heavy index. Okay, and I'm going to agree to buy it for $290 a share. It's trading at almost $295 a share. So even if it goes to 285 or 275, it doesn't matter. I'm guaranteeing it, I'm guaranteeing to buy it for 290. The reason I don't care, again, guys, is because I think it'll be worth a lot more in the future. So if that's my worst case situation, I'm more than happy to do so. Okay. Now, let's take a look at what happens if we actually own a stock. Well, what happens? Right? Like, what happens if, like, oftentimes you're going to have to get to buy a stock. There's no getting around that. Okay. Or an ETF. If you don't want to buy one stock, you can buy an ETF. All right. So let's take a look at our first position here, which is AAPL, Apple. Okay. Apple is trading for $148.22. You can see last month, if you can see our position here, you can see that I agreed to buy Apple for $147.63 under position here, okay? Right there, okay? Average price. So I say to myself, okay, I agreed to buy Apple. Fantastic. You know, I made a bunch of money when I agreed to buy it. Okay, fine. But, you know, now I wouldn't mind getting rid of some of my Apple shares. I have 300 of them in this case, okay? Even if I had 100, do I want to get rid of it? Okay, we'll see. And I say to myself, you know what? I'd be happy to get rid of some of my Apple shares. In this case, I'm going to use my technical analysis, and it tells me about 157.50. And that's where I'd be happy to get rid of some of my shares, 157.50, okay? Or maybe even 155. Let's examine both. All right, so remember I bought it for 147 and change. So I got paid a bunch of money when I agreed to buy it. Great. Now that I own it, I'm going to agree to sell my shares for a certain profit, okay? In this case, $155 or $157.50. And I say to myself, you know what? I'm going to go for, I'm going to go for 155 here, okay? And I'm going to do a sell order here. I'm going to do 2 contracts, which means each contract represents 100 shares, okay? Going to go ahead and do it. Oh, order filled. Fantastic. Great. So what I'm doing in this situation is I am giving up my upside, okay? So if this stock happens to run beyond 155 between now and March 31st, well, I'm going to give up my upside beyond 155. However, I was compensated $2.12 a share just for giving up my upside, okay? And remember, out of this entire scenario, okay, the worst case situation that happens to me here is that I own shares, i.e. being a part owner, in a bunch of companies like Apple or Microsoft or Tesla that I would have been a part of anyways. I would have bought these shares regardless of what happens because I want to own them for the long run. So my point is, I'm making my worst case situation owning stock in companies I wanted to own anyways. That's the worst that'll happen to me. That's it. And that allows me to sleep a well night. I'm able to trade within 30 minutes a day because I know my upside and my downside. I don't have to spend a lot of time analyzing stuff because, again, I know what I'm looking for, and I can do this anywhere in the world. It's a really, really good spot to be in, okay? So Davel has a question. Can you please tell us about margin as we have to use margin account Even if we have money, can you please tell us how that works? Absolutely. All right, so double. How margin works is this. When you open an account, in order to trade options or in calls and puts, which is what we do here at Theta, this is, like I said, this changed my life. We have to open a margin account. And a margin account means you can margin it. It's marginal. Meaning, if you put in, okay, in this case, if you look at the top right-hand corner, it says NLV. That's my net liquidation value. I started this account, this fake account, at $1 million. Now it's grown to $1,027,000. Okay, so I made $27,000 over the last 2 months, roughly. Okay, but a margin account, what a margin account allows you to do, it allows you to agree to buy a lot more shares for money that you may have. Okay. And that can be extremely dangerous. In fact, I will almost guarantee you, if you use margin, all right, and that means basically taking on a lot more risk than you need to perhaps take on, eventually you will get burned really, really badly. Okay. So I tend not to invest more money than I have. What margin allows you to do is invest a lot more money than you actually have. And what happens is if the market pulls back, that can get extremely dangerous. Your account can get absolutely wiped out. That is not what we do here at Theta. Our job is to make a good amount of money, sleep well at night, and be done in less than 30 minutes a day. That is our goal. All while leaving the worst case scenario. The worst case scenario here is that we own a stock in a company we like Apple, or like Microsoft or Tesla. And that's not meant to be a stock recommendation. It's only meant to tell you that the worst case situation we want to put ourselves in is if we own a company that we love. That's a really, really good spot to be in. Paul asked a question here. If a stock ETF does get a big and prolonged plunge after we agree to it, are we stuck holding it for potentially a long time until hopefully it recovers? Yes, Paul. Yes. Remember, Paul, I want to make this clear. Our first job is to never, ever lose our money. That's like, Warren Buffett stuff. Like, you don't want to lose your money no matter what happens, right? And hopefully, like I said, we can write some covered calls like I did with Apple here, where we can agree to sell our shares for a profit. But yes, so you'll find oftentimes for years and years and years, you've been making a ton of money. And then you'll have a really poor year like last year we had, 2022. And you'll have to wind up holding your shares for a period of time. But the point is, the worst case situation is that you have to hold your stock. To me, those are good spots to be in because I don't want to incur a permanent loss of capital. So the second part of your question, are those funds tied up all the time? Again, not necessarily. You can write covered calls like we discussed here. In that case, could just do 1 or 2 events drain a trading account that holds maybe 50K. Again, if you're not trading with more money than you have, unless the world comes to an end and things get really bad, would I expect your account to be drained? Any company can go down the toilet. Any company, no matter what. But we generally think that we pick high quality companies. Okay, that's the first thing. Rita says, how many shares do I have to buy in any given transaction? So Rita, you have to buy at least 100 shares. Okay, so let's put an example here. This is Tesla. Okay, Tesla is a company that produces, as you guys know, a lot of cars, electric cars. They do a lot of other stuff. But the point is, you have to get to know the company. That is your job. We will help you with that. We will give you all the knowledge possible that we have to help you get to know this company. And then you say to yourself, you know what? I think Tesla will be worth more in the future. Again, that is a decision that you have to make for yourself. So what you can do is you can say Tesla's worth $207 today. In a year, 2, 3, 5, 10, etc., I think it'll be worth a lot more. So I certainly don't mind the worst case scenario where I have to own Tesla. That's the first and foremost thing here at Theta always. You have to believe that this thing will be worth more in the future, okay? And once we've done that, we say to ourselves, let's enter the options market in order to be able to buy it cheap, okay? So again, I'm gonna go to the top right-hand corner here under options and spreads, and I'm gonna press this button here. All right, and I'm going to go out again about 30 days, okay? And again, there's a very specific reason we do that, right? There's a very specific reason we do that, is because we want to go out at least about a month. That's where our sweet spot is for this thing called theta decay. There's a reason we named our company Theta Trading. It's what gives us our superpower, okay? And I say to myself, you know what? I want to own this thing based on my technical analysis for about $200 a share. Okay, great. So I'm going to go ahead and do that trade. All right, so getting back to your question, Rita, and it was good talking to you last week. You have to agree to buy at least 100 shares. So as you can see, this quantity number here, quantity contract, 1, 2, 3, etc. Each quantity represents 100 shares, okay? So I am agreeing to buy Tesla for $200 a share. That means I have to agree to buy at least $20,000 of Tesla shares. 100 shares times $200 per share, right? So 100 times 200 equals 20,000. I'm agreeing to buy $20,000 worth of Tesla between now and March 31st, okay? Great. Now, if you don't have 20 grand, and I can assure you, I didn't have $20,000 when I first started this out either. I had nothing but negative money and a bunch of student loans. So I would say focus on the knowledge until then and open a paper trading account, meaning a simulated trading account, and start doing the homework. Watch our YouTube videos, understand how the mechanics works. If you can afford it, take the course. Take the introductory course. It's exactly what we would have wanted to know when we first started investing, myself and my business partner, Matthew Dunn, when we were dead broke and had no money, okay? Now, you can start trading after you know this, but in the meantime, practice, practice, practice. If you make some mistakes, it's okay. It happens. But the point is, you have a lot of choices. The idea here is this is a lifelong skill. You don't have to rush it today or tomorrow. It's a lifelong skill. So getting back to this Tesla example, guys, I'm going to agree to buy some Tesla, like I said, for about $200 a share, okay? Actually, I just did. But let's see if we can do some more. So let's go back to our account here, and we look at our portfolio. There we agreed to buy some. We've agreed to buy one contract. Let's agree to buy one more contract, okay? So let's go ahead and do this trade. So again, we always sell options. So on the bottom left-hand corner, guys, we are selling an option here, okay? Market. Just curious, curious, guys. This changed my life, right? It did. Now that you know that you can buy stocks for cheaper than they're actually cost, and you get paid a bunch of money for it, would you go back to doing it the old way? Tell me if you would. Just please, anyone. Would you ever go back to buying it the old way? To me, it's a no-brainer. I would never go back. No, exactly, double. No way. Why would you ever go back? If you know that you can get a great deal on a company that you want to buy it for cheaper, and you can get paid a bunch of money, and the worst thing that'll happen to you is that you own that company. Well, why not? Right? And Rita asked the question here, does all stocks have options? No, Rita, not all stocks have options. Some stocks do not. Let's take a look. But most of your bigger companies, Rita, do. All right, so let's take a look at an example. Let's say we like Royal Bank of Canada. You know, a lot of us have heard of this company, especially if you're Canadian. We have people from all around the world who are part of our community. And we said to ourselves, Royal Bank is at 137. Okay. You know, I don't mind buying some Royal Bank at about 135. Okay. Let's see if I can get paid some decent money just to agree to buy it for 135. Okay. I have to go to March 17th here. Okay, it looks like just for me to agree to buy it for 135, I'm getting paid about 95 cents a share, which is over 1%, because this is about 2 weeks. So for the month, actually, that's about almost 1.75%. And the worst thing that's going to happen to me here, guys, is I own the Royal Bank of Canada. But if I want to buy the Royal Bank of Canada, I'm certainly happier to buy it for 135 or lower and get paid, as opposed to just simply buying it for 135. So again, I can do this on a lot of different companies, but the primary focus here, guys, is it has to be on a company that I like, that I know, that I've done my homework, that I think will be worth more in the future. And I do that through options, particularly selling of options. Now, that can be very powerful, but you have to know what you're doing, okay? You have to know what you're doing. Like I said, it may seem easy, but there is a lot to learn in what we do. The reason we started this company here at Theta is because we wanted to create the exact course that we would have wanted when we first started investing in the late 90s. We had no idea what we were doing. You go to university and you come out financially illiterate, you have no idea what you're doing. It was terrible, quite frankly. So that's why we started this company. Okay, guys? A few questions here, guys. And again, please ask all the questions you want. Be happy to ask them. Anna's asked, what would you be advised to how to start a strategy if you have a small account? For example, my budget for now is $20,000. Are there any companies I can start trading options now? Or is it better to save more money? Good. Yeah, Anna, very good question. Again, Anna, I would probably look at an ETF if I was you, or I would wait till I have more money. Either one. Like I said, with the ETF, for example, okay? So I say to myself, let's say I like banks, okay? There's an ETF called XLF. Now, it's not just banks, it's banks and insurance companies in the United States. Again, you would have to look up what this ETF actually, what is held in this company. Like an ETF is an exchange traded fund. It has a bunch of stocks all rolled into one, okay? But if you believe in banking, if you believe in insurance for the long run, you say to yourself, you know what? I believe in this stuff. Okay. And you can see 5 years ago, the value of this ETF was, let's see here, about $27. So it's gone up a fair bit since then, $28. Now it's at $35, and it's been paying a dividend yield of 2.3%. It's been a bit of a bumpy ride because of all the stuff we've had in the last couple of years, COVID, et cetera, et cetera. And you say to yourself, you know what? I'd like to buy 100 shares of this, and I'd like to go to March 31st. Okay, great. It's at $35.79. But remember, you must believe in this. And you say to yourself, I'd be happy to buy some of this at 35, even though it's at $35.79. Okay, great. And what does that pay me? That pays me 54 cents a share was the last trade, okay? And 54 cents divided by $35 is over 1.5% for the month. If my worst case scenario is that I own a bunch of these banks and insurance companies for below what they're trading at, and I got paid 1.5% for the month, that's something. If I was happy to own these insurance and bank companies, that is something I would definitely look into, okay? So, and that trade, by the way, would cost me about $3,500. So on that $3,500, again, it's not a huge amount of money. I understand that. On that $3,500, sorry, in this situation, it's not $3,500. I've agreed to buy 2, okay, which is about $7,000 of stock in XLF, okay? But for that, I got paid $98 US. So $98 US for 1 month. And the worst case scenario is I own Bank of America and Citigroup and a bunch of other top financial institutions in the United States. Well, if I'm okay with that, I'm more than happy to take that money. And this is what allowed me to get my financial freedom, guys. 99.9% of people will never know the strategy even exists. The main thing for people who are going to use a strategy, it's a great strategy for long term, but you have to be disciplined. If you agree to buy shares in companies that you know nothing about, because your neighbor told you about some up and coming new weed company that's going to go to the moon and back, and it gets absolutely killed, well, that's on you. We only do this after doing an extensive amount of homework on companies we want to own. And if, like I said, if you don't want to do that extensive amount of homework, no problem. You can bet or invest on the entire index, right? The S&P 500, the QQQ, etc. But it has to be 100 shares, okay? Anna asked, my intention at first was to use some line of credit, but with this increasing interest, I don't think it makes much sense. It's one. That's another really good question, Anna. A really good question, actually, okay? I'll give you an example here. Let's look at Royal Bank, okay? And you know, like if you use a HELOC right now, you're probably looking at somewhere around, I don't know, maybe 6.5% that you're going to be paying on the interest, okay? Now, as you can see, even if you have to own Royal Bank here, if you guys look at our market data here, okay, on the right-hand side, you can see something called DVD yield. That's 3.8%. That means even if you had to buy the Royal Bank of Canada shares in this example, you would still get paid 3.8% just as a dividend because you're a part owner of the company. That's your portion of the profits because you're an owner of the company, okay? So you'd get paid that much money, 3.8%, not bad. But it still won't be as much as the 6.5% that you may have to pay on the line of credit. So if you're going to be using borrowed money, you must be extra careful. Like, I mean extra careful. I have definitely done it in the past, but I've done it in a lower interest rate environment, so you have to make sure that you can handle the additional payment. Sorry, guys. So Les, what would you say is a good starting budget? I wouldn't say there's a starting budget. I would say more like, when I started, like I said, I had negative $30,000 of student loans, so I had no starting budget. I wouldn't say a starting budget is the biggest point. I would say is focus on the knowledge. Watch our YouTube videos. Excuse me, guys. Got a bit of a hard one. Learn from our mistakes. What we did right, what we did wrong. Learn from all that stuff. And then go from there. The reality is in this scenario, in this strategy, the more you have, the more capital you have, the more that you can make. Okay. Now that doesn't change anything in the sense of long term. Okay, if you have $1 million, yes, you can make a ton of money doing it. But if you don't have knowledge, are you going to be able to? I would say the answer would be no. So my point is I would focus on the knowledge first, and then I would worry about the money. Money comes from knowledge. It doesn't happen the other way around. Okay. All right. Guys, any of the questions that you guys would like to answer? I apologize again. All right. Any questions, guys? I hope you guys can see why this is such a game-changing strategy. It can literally change your life. If you can sit on a beach somewhere, anywhere in the world, and agree to buy stocks and companies that you buy anyways, and make a bunch of money doing so, isn't that a really good spot to be in? I would think so. Devil says, as far as I understand, even if we have money to buy 100 shares, they still use margin. So you can explain about this, as we can see on your screen, maintenance margin. Again, Devil. So, okay. So you can see on my thing, maintenance margin, okay? You're right. Again, if you can see, look at the top right-hand corner where it says NLV, okay? NLV. I started this account, like I said, with $1 million in January, and now it's at $1,027,000. So I made 27 27,000 in the last 2 months. If I agree to buy more than $1,027,000 of stock, plus the amount of stock I already own. So for example, you can see here, I already own 300 shares of Apple. Well, there's I cost money for it, right? And you can see I've agreed to buy 300 shares of more Apple at 147. Okay, great. I've agreed to buy 400 shares of AMD, which is Advanced Micro Devices, at $79. Once this money adds up to more than $1,027,000, I am using margin or borrowed money. Borrowed money can get you into a lot of trouble, guys. Like a lot of trouble. It could really ruin you. So it is incumbent on you not to use more money than you have. So if you look here, it says net liquidation value, or NLV, $1,027,000. Okay, great. And then you see here, it says something we go buying power, right? I'm going to just see if I can highlight this. So under simulator trading, and it'll say SMA and then buying power, 2.459 M. That means I can agree to buy almost $2.5 million more of stock than I actually own to have in my account. We don't do this, okay? So you are correct. You can use more money than you have, which is margin. We don't do this, right? If we do, it'll be to a very low extent. Why? Because every so often the markets get absolutely killed, like last year. And our first job is to protect our money. So if we agree to buy a whole bunch more stock than we have money for, we could be in big trouble. So we don't, we want to sleep well at night. We want to spend 30 minutes a day doing this. And you know what? We don't want too much stress. If you agree to buy a whole lot more stock than you have money for, you could be in all kinds of these bad situations, and we don't want to be there. Okay? Tuan says thanks, and we shall speak soon. Okay, fantastic. Dev, I posted one. Thank you, Devil. Read out. What's the difference between buy and sell in terms of money, or you make money in the payment? We always sell options, Rita, because we either want to agree to buy our stock or sell our stock for a certain price and pay in time. So for us, we're always on the sell side. So if you look at my positions on my options, there's a negative next to each one of them. That is because I have agreed to buy stock. So for example, right, a little while ago, I agreed to buy, let's see here. Well, let's do this one. I agreed to buy 200, okay, so 2 contracts, okay, of Tesla for 155. That's when it was trading about 195. So it was $40 away. I agreed to buy 200 shares, which would have cost me $31,000 US. Okay, great. But for that, I was compensated $668. That to me is a fantastic return. I'm more happy to take that return. Okay. You're going to pay me $668, which is over 2% for the month, for agreeing to buy a stock which is $40 lower, and I wanted to buy anyways. I'll take that all day long. Okay. So I think that's what you mean, Rita. We simply agree to buy a stock for lower than it's trading for, because we are acting as a de facto insurance company. We are guaranteeing the buy price on a stock that we wanted to own anyways. Okay. Leaving ourselves in a worst case position where we have to own that company. Oh, great. In this case, it was Tesla. If you don't want to own the company, you don't have to. You can look at owning the entire index, which is what we've done here as well. So I hope that answers your question, Rita, and I hope to teach you really soon, okay? Fantastic. Thank you, Rita. All right, guys. Does anyone else have any final questions? If not, this will be posted to Instagram. And YouTube, please watch the replay. I guarantee you guys, this is an absolute life changer if you take the time to learn it, okay? All right, guys. Take care and talk soon. Omar Khan here from Theta Trading. Talk soon, guys. Bye-bye.